Gold just jumped nearly 4% in a single day. After weeks of pure pain and confusion, the market sent a shocking signal today. Everyone said gold was finished. Everyone said the rally was dead. I'm telling you, they were wrong. Today, March 25th, 2026, gold is trading at approximately $4,159 per ounce. And there is a very specific reason this bounce happened today. But here's the twist nobody is telling you. This dip you just witnessed, it may have been the single biggest buying opportunity of 2026. Stay with me, because by the end of this video, you will know exactly what to do next. Let's go back to the beginning of March 2026. Gold was trading near $5,214 per ounce on January 28th. That was an all-time record, a historic high. Then came the shock. On February 28th, the United States and Israel launched coordinated strikes on Iran. The Middle East exploded into full military conflict. The Strait of Hormuz, the choke point through which 20% of the world's oil flows, was effectively shut down. Oil surged from $81 to over $106 per barrel in just weeks. Inflation fears spiked hard. Here's the part that confused everyone. Gold dropped. Yes, gold fell during a war. It crashed more than 20% from its January peak by mid-March. Why? Because the dollar spiked on safe haven demand. Because leveraged institutional traders got margin called and sold everything, including gold. This was not a sign that gold was broken. This was panic selling. Pure short-term noise. Now here's what changed on March 25th. Reports confirmed that Washington and Tehran are actively negotiating. President Trump said on Tuesday, "They're talking to us and they're talking sense." Oil crashed. Brent crude dropped more than 10% in a single session to around $100 per barrel. The US dollar index fell below 100, and gold surged nearly 4%, reclaiming the $4,150 level. Inflation fears are cooling. The war premium is being stripped away, and gold is reacting exactly the way it should. Now let me walk you through this like a real investor. Step 1, understand what this correction actually was. This was not a structural collapse in gold. This was a forced liquidation event. Leveraged traders facing margin calls sold gold, not because they wanted to, but because they had to. That is a gift for long-term investors. Step 2, look at the technical signal. Gold bounced hard off its 200-day simple moving average near $4,100. That is one of the most important technical support levels in any market. A bounce off that level is a major signal. Step 3, check the macro drivers. The US dollar is weakening again. Oil prices are cooling, which reduces inflation pressure, which opens the door for the Federal Reserve to cut rates. And lower rates are rocket fuel for gold. Step 4, ask yourself, has anything fundamentally changed? US fiscal deficits? Still exploding. Global debt? Still at record highs. Central banks buying gold? Still happening at historic pace. The answer is no. Nothing fundamental has changed. The correction was 100% driven by short-term crisis mechanics. Step 5, decide your entry. The zone between $4,100 and $4,500 has now been proven as strong support. We are currently in the recovery phase from those lows. This is not the time to panic. This is the time to think clearly. I am telling you, investors who buy gold in periods of temporary panic consistently outperform those who chase highs. History proves this every single time. Now let's talk about the numbers that matter. Because what the big banks are forecasting right now will unthink everything the pessimists told you. JP Morgan, the largest bank in the United States, recently revised its gold price target to $6,300 per ounce by the end of 2026. Read that again, $6,300 from today's $4,159. That is a potential gain of nearly 38%. Goldman Sachs forecasts gold reaching $4,900 per ounce by December 2026. Bank of America sees gold hitting $5,000. Deutsche Bank revised its 2026 target all the way to $6,000. UBS raised its gold forecast to $6,200 by September 2026. Wells Fargo upgraded its target range to $6,300. And Yardeni Research, they are calling for $6,000 by year end and $10,000 by the end of this decade. Listen. When JP Morgan, Goldman Sachs, Deutsche Bank, and Bank of America are all pointing in the same direction, you pay attention. Now, why are they so bullish? 3 reasons. Number 1, central banks are buying gold at historically elevated rates, projected at around 755 tons in 2026 alone. Number 2, the US dollar is structurally weakening because of fiscal deficits and debt. Number 3, the Federal Reserve is expected to cut interest rates further through 2026, and lower rates make gold explode higher. Gold has already risen more than 25% since early 2025. And today's dip back toward $4,259, According to Goldman Sachs, this pullback is completely in line with historical correction patterns. It does not change the long-term trend, not even slightly. Here's the part of the story nobody is discussing on mainstream financial media. Listen closely. While retail investors were panicking and selling gold during March's decline, central banks were quietly buying. The World Gold Council confirmed that nearly 95% of global central banks plan to increase their gold reserves in 2026. China, Poland, India, Turkey. They are all systematically replacing US dollar reserves with gold. And here is the brutal truth about why. In 2022, when the US froze Russia's dollar reserves as a sanction, every central bank on the planet received a big wake-up call. As Goldman Sachs Commodities chief Don Striven described it publicly. The message was clear. Dollar-denominated assets carry political risk that gold does not. Now, here's the curiosity gap I want you to think about. If central banks, who have access to the deepest financial intelligence on the planet, are still buying gold at these price levels, what do they know that the panic sellers in March 2026 do not? There is something else. This month's crash from $5,400 to $4,098 happened. Despite a live war in the Middle East, the war premium was stripped out, the margin call selling was triggered, and yet gold bounced hard off $4,100 and $100 and is already recovering. That bounce off long-term support, combined with easing geopolitical tensions and a weakening dollar, is what technical analysts call a reset, not a breakdown. Gold did not break, it reloaded. Now let's talk about the practical real-world strategy, because knowing the data is one thing, knowing what to do is everything. First, how much should you allocate? Most financial experts and institutional advisors recommend between 5% and 15% of your total portfolio in gold. If you are a beginner, start with 5% to 10%. If you already hold gold and want to increase exposure, this dip zone between $4,100 and $4,500 has now proven its support. Dollar cost averaging, buying a fixed amount every month, removes the stress of timing the market perfectly. Second, physical gold versus ETFs, which is better. Physical gold, bars and coins, gives you zero counterparty risk. Nobody owes you anything. You own real metal. For long-term wealth protection and inflation hedging, physical is ideal. Gold ETFs, like ticker GLD, offer liquidity and convenience for shorter-term positioning, or if you want to buy more frequently. Both have a place in a balanced strategy. Third, the biggest beginner mistakes to avoid. Mistake number 1, selling during panic events exactly like March 2026. Mistake number 2, buying all at once at a peak instead of spreading your purchases. Mistake number 3, ignoring storage costs and insurance for physical gold. Mistake number 4, expecting gold to behave like a stock with constant upward momentum. Gold protects wealth over time. It is not a get-rich-quick trade. It is the most proven wealth preservation asset in 5,000 years of human history. If this video gave you real, data-backed clarity on gold in 2026, then do one thing for me right now. Hit the subscribe button. Because this channel exists for one reason only, to give you the real information that protects and grows your wealth. And drop a comment below with the words, informative video and subscribed. It tells me you are serious about your financial future, and it helps this channel reach more people who need this information. See you in the next video. Do not let the noise win.